Welcome to this explainer. If you've ever looked at the world of global finance and thought there was basically only one way money makes money, well, you are in for a really fascinating journey today. Right alongside the conventional financial system we all know, the one built on interest rates, debt, and Wall Street trading, is this massive, rapidly growing, parallel universe. It's a completely different financial ecosystem, and it's built on an entirely different ethical DNA. So today, we're going to dive right into the mechanics of both systems to see exactly how money makes money when you completely rewrite the fundamental rules of the game.
Okay, let's dive into this. If you think this might just be some niche topic, consider this number, 1.8 trillion Malaysian ringgit. That is the size of Malaysia's Islamic capital market alone. It makes up more than 60% of their entire capital market. So this isn't just some small, quiet corner of the industry. It's a heavyweight system moving massive amounts of capital all over the globe, with Malaysia really leading the charge as a primary hub. If you're looking to truly understand modern global wealth, you absolutely have to understand how this system operates.
And hey, this definitely isn't just a side hustle for the economy. When you look at the entire Malaysian banking system, it's a near even split. We're talking 44.5% of total financing being Islamic, while 55.5% is conventional. This is what's known as a highly successful dual banking system. Basically, you have these two vastly different financial philosophies operating right alongside each other every single day.
So here is our roadmap for today's explainer. We're going to cover 1. A tale of two markets, 2. Debt versus risk sharing, 3. Bonds versus sukuk, 4. Strict rules and heavy fines, and finally 5. Roadblocks to global expansion.
All right, let's jump straight into Section 1, A Tale of Two Markets, the Foundational Divide.
So while conventional capital markets generally aim to maximize profit, often through interest-based transactions, the Islamic capital market is governed by Sharia principles, and that means there's an absolute strict ethical forbidding of three main things. First up is riba, which basically means interest. Second is gharar, which translates to excessive uncertainty or ambiguity in a contract. And third is maisir, meaning gambling or excessive speculation. The whole entire system is built on this core idea that financial returns have to be tied to legitimate, ethical, economic activities and real social welfare. It can't just be about making money from money.
Moving on to Section 2, Debt versus Risk Sharing, the Structural DNA.
Now, what's really interesting here is the stark contrast in how these two systems actually handle risk. In conventional finance, it's primarily debt-based, right? Investors generally get fixed returns, which transfers the risk pretty much directly to the borrower, who has to repay the loan and interest no matter how poorly their business might be doing. But because the Islamic market totally bans interest, it has to rely on asset-backed financing and profit and loss sharing instead. Through contracts like musharaka, which are essentially joint ventures, both the investor and the entrepreneur share the liability and the returns. Basically, you win together or you lose together.
Which brings us to Section 3, Bonds versus sukuk, the instruments.
Okay, think about buying a regular bond for a second. You're lending your money to a company or a government, and they promise to pay you back with fixed interest. It's a pretty straightforward debt obligation. Now, imagine instead that you're buying a tiny slice of an actual physical project, like a brand new toll road or a hospital. That is what a sukuk is. It represents proportional ownership of a tangible asset. Your returns don't come from some arbitrary interest rate. They come from the actual rent or profit generated by that specific physical asset. It's a totally different mindset.
And we actually see this exact same philosophy when it comes to short-term liquidity, specifically with repos. Financial institutions constantly need short-term cash flow, right? Well, conventional repos are basically secured loans that generate interest. But Islamic finance achieves the exact same economic goal without charging a dime of interest. How? Through these really transparent mechanics called sale and buyback agreements. They literally sell the asset and agree to buy it back later, completely avoiding the whole concept of a traditional loan. They reach the exact same destination, but taking this path means they avoid creating artificial money bubbles.
All right, Section 4, Strict Rules, Heavy Fines, the Enforcers.
So it's an interesting comparison. The source notes that conventional financial markets are fundamentally regulated through free market mechanisms and central bank interest rate adjustments. But because that system relies so heavily on debt-based instruments and speculation, it can sometimes be exposed to severe financial instability. The source points to the 2008 global financial crisis as an example of what can happen when those free market mechanisms falter under the weight of excessive risk.
But in contrast, the Islamic financial market, it's overseen by some incredibly strict, escalating governance. Since 2010, Malaysia's central bank has built what's essentially a regulatory fortress. They moved from a foundational governance framework in 2010 right up to the sweeping Islamic Financial Services Act in 2013, and then tightened things even further with a rigorous policy document in 2019. So this is not just self-regulation, it's a multi-tiered legal stronghold.
And if you want to know just how uncompromising this oversight really is, listen to this quote from Section 28 of the 2013 Act. Failure to ensure Sharia compliance permits the convicted party to be jailed for a maximum period of 8 years or a heavy fine of up to 25 million ringgit or both. Let that sink in for a second. Failing to comply with Sharia financial principles isn't just a slap on the wrist or, the cost of doing business. It is a severe criminal offense that could literally cost you your freedom.
So, this brings us to a really fascinating pivot point for this explainer. If this market is so resilient, so heavily governed, and carefully avoids the speculative debt traps of the conventional system, why isn't it completely dominating the globe?
That takes us straight into Section 5, Roadblocks to Global Expansion, the reality check.
First up, we've got the structural challenges. The Islamic market faces absolutely fierce competition from a conventional market that is older, much bigger, and far more liquid. Plus, because Islamic banks can't use traditional interest-based liquidity tools, they often run into short-term funding crunches. Add to that a massive harmonization problem. A financial product that gets approved by Sharia scholars in one country might get completely rejected in another. That kind of inconsistency creates a lot of uncertainty and drastically spikes compliance costs for international institutions.
Then there's what we call the literacy gap. And this is a massive roadblock. Huge pools of global capital just stay away simply because people falsely believe these instruments are exclusively only for Muslims, or they think that because they don't charge interest, they must be purely charitable endeavors rather than, highly profitable investments. This widespread misunderstanding leaves a lot of investors unable to correctly evaluate risk profiles, especially when looking at complex structures like sukuk.
Next up is the legal and human capital crisis. Think about it. When a massive sukuk deal has a dispute out in the real world, it often ends up being litigated in conventional civil courts. The problem there, the judges are using standard civil law and completely lack training in Islamic contracts. So there is a severe talent gap right now. The market desperately needs professionals who are highly educated in both modern quantitative finance and classical Sharia law, and honestly, there just aren't enough of them to go around.
Finally, we have the digital lag. While conventional markets are just sprinting forward with AI and blockchain, the Islamic financial industry has been a much slower adopter. Part of this is institutional hesitation, for sure. And part of it is just inadequate tech infrastructure in emerging markets. And as they do try to transition to digital tools, they face amplified cybersecurity risks. In a market that's already battling low public awareness, a major data breach could be utterly devastating to consumer trust.
Which kind of leaves us here. Despite all these hurdles, the Islamic capital market represents a 1.8 trillion ringgit proof of concept in Malaysia alone. It absolutely proves that a massive financial system can exist and thrive without interest or speculation. So as global markets continually seek stability during turbulent times, could a system built fundamentally on risk-sharing and tangible ethical assets eventually challenge our traditional debt-driven world? Thank you so much for joining me on this explainer. I really hope this deep dive leaves you looking at the global financial universe in a completely new light.